Some more wild swings today. No surprise though, right? All right, awesome. Thanks, Kevin. Hey, long time. I know. Don't start now, Trip. I don't need to find squirrels yet. There'll be plenty of them. Good morning, Helen. What's up, David? I don't know where she's at yet, Brenda, but I'm sure she'll show up. Let's see your hair. I have little doubt that she'll be here. She was sitting up on the router a little bit ago, so I'm sure she'll make an appearance. She's trying to get famous, so let's get the disclaimer out of the way. Oh, that's right. You're on East Coast, huh? Forget that it's not morning for everybody. I am not a registered broker-dealer investment advisor. I'm not going to give you any recommendations or advice. Everything we do here is purely for educational purposes. If I do happen to mention a trade, just assume it is a paper trade or practice trade. For regulatory reasons, we do not discuss funded trading. Oh, her name's Trixie. It was kind of weird. The lady that gave her to me named her, so, and the kids liked it, so they wanted to keep it. I want to change it to Lucy, but I don't know why. So we'll see. For those of you that don't know, Trixie the trading cat. I don't have any pictures up, and I'm not going to spend the time going and grabbing them, but she loves to sit. She'll come and just lay on my hand. I'm trying to run the mouse, trying to work, trying to trade, and it's like she just shows up and does her thing. We'll just flat out lay on my hand. She'll come grab my hand and bite it. And she's pretty crazy, but she's been a lot of fun. She's a little bit like a dog. I didn't know that until I did a little research on Maine Coons, but so she usually prefers to be in the same room that I'm in. But here's what's coming up. We got the premium online workshops, December 11 and 18, check in, and then the monthly December 14th for Inner Circle. Trading You Live 2.0, December 11th at 8 p.m. Eastern. Mastermind Group, December 12th and the 19th at 8 o'clock. SPX Cash Flow Secrets, December 13th at 8. Monster Market Movers, December 18th at 8. And then Power Option Plays Tuesday and Saturday. Covered Call Explorer on Thursday with Trip. Believe you're doing that now, right? I think you've fully taken over, if I remember hearing that right. Awesome. Awesome. I didn't get in and check it out, even though I'm not a covered call guy. But we will talk a little bit about that today. So I hope I don't steal any of your thunder. But and then free online workshops, Power Hour every Monday. Trading Coaches Playbook, this one every Friday morning, or Friday at noon Eastern time, I should say. Maybe because it's the mouse. Oh, the cat. Okay. I was like, wait a minute, where'd that come from? Actually, honestly, that's part of the reason I got her, even though I don't have a mice problem. The neighborhood I'm in is only like 4 years old. We have lots of rabbits here. And apparently she doesn't even like to go outside. I've left the slider open. She just stands there and looks out and sniffs. I've tried to get out in the garage a couple times. I don't really want to let her out because there's lots of dogs in our neighborhood, and I don't think she'd get along with them. But
order filled.
So yeah, she really has no interest in going outside, which I don't blame her. I mean, it's cold and rainy and wet right now, so you got a nice comfy house to lay around, lots of places to lay. I know. I don't know what it was. It's behind the screen. I meant to move it up on that other screen so I can see it, but hopefully it's not my stop, but it might be. So, but evening think tank, Monday, Wednesday, Thursday. And then Vegas spread mastery with Sean. In fact, give me just a second here. You know what? We'll just throw it up on there and see what happened real quick. That's what I figured. That's what I figured. I hit a stop, but that's okay.
Order canceled.
Close out the other one. So took a hit. Oh, well. Happens. We'll see. Look for another opportunity down the road. Where we go. Get back to where we were here. Whoops. Oh, we did start off where. All right. Sorry about that. Just had to make sure I had another order in there. I wanted to make sure it was canceled. So. That's okay. Getting dinged is okay. As long as the ding is not huge. So was expecting Gold's sitting at a major trend line, 2019. And I was expecting it to bounce. It did bounce first thing this morning, which I plucked a little bit out of that. Then it came back down and started to hold the line. Thought we were going to have a double bottom. So I picked up just a little position and seeing if it would go again. And it didn't. It just cracked it. So we'll see if it stays down there, which is not good for the AEM option trade I have on, but I don't think it's going to stay down here. So we'll see. All the social media places you can find us on, of course. And yes, I'm still drinking coffee because it's only 9 o'clock out here. I started drinking coffee at 5:36 this morning, and I drink it usually till 3 or 4 in the afternoon. So, but these are all the tools that I have, patterns in a flash. Some of you have experienced that, had that in the past. Maybe you still have it. Some of you probably still have it. Weekly whispers. So every week I put out 20 to 30 candidates, except for this week, there's only 12, which was crazy. I very rarely get below 20. Usually it's 20 to 25, sometimes as high as 30. I've had as high as, I think, 35. But I just go hunting for patterns, find patterns, narrow them down, say, here's the cream of the crop that I'm watching for this week. I only look once a week, and then those are the trades, those are the candidates I watch for the week. So looking for a good, consistent, reliable pattern. And yeah, this week there's just almost nothing there. And then small account, big returns. This is a pre-recorded class. Actually, these are all basically on demand. So you can get them anytime you want. So I think I usually average about 4 cups a day. So it's not like a ton. I don't drink constantly, and I'm usually sipping on it. After the first couple, it's usually I slow down quite a bit. So I'm not like chugging them all day. It's not like water. Water I chug all day to offset the coffee. So I thought this was funny. Took me back to my childhood. For whatever reason, last week, my neighbor and I were talking about that and how, we were young and dumb and we used to go TPing. But I haven't seen that. I don't know if the kids do that these days or not. I don't think it's cool anymore. I think they're too busy with their Xbox and their phones to go out and have some real fun and take a 6-pack of rolls and just throw them and then admire your work after you're done. And then I saw this one, of course. I thought it was even better. This is for you ladies. Sorry, ladies. Had to say it. Over or under is always the debate, right? I thought this was kind of funny. All right. Let's get to the topic of the day. What if? What happens if bear shows up? Which those of you that know me know that I have been bearish for quite some time, like 2.5 years. Oh, really? That's funny. And this year actually has been kind of surprising to me. It's been more bullish than I expected. I actually thought we were going to have at least continue the bear market and possibly even get a crash at some point this year. And it not only hasn't happened, the market has bounced in a relatively big way, significantly more than I would have thought. When you look at the economic data and you dig past the surface and the superficial stuff that they show you, then the picture's not very pretty. Yeah, I'm glad you reminded me of that because I've been hitting on that a lot lately. And even look at the employment number that came out this morning, which was kind of stunning to me. And now I'm going to look a little bit stupid, but I don't care. It's not the first. It won't be the last. Because I said in the recording last night from my Weekly Whispers subscribers that I was expecting unemployment to go up, maybe a lot. I figured it would stay about the same, which is what the average economist expected too. Nobody expected it to drop off. Especially with, and the JOLTS number came out, Tuesday, I think it was, which is not going to translate that quickly. The unemployment number is once a month. But, and anecdotally, I know people that have gotten laid off. And I've met people recently just at coffee shops. You just start yakking with and start a conversation and like, yeah, I just got laid off. That's why they're at the coffee shop. They'd be working. They're looking for jobs, whatever the case is. So yeah, it's I would have expected, based on not only other data but anecdotal, just life experience, that unemployment would have gone up. But here's the part that they won't tell you. You see the headline number, and the part that isn't on the surface with that headline number is that they're also have started, I don't know when they started, but they started keeping track of multiple jobs. If you have more than one job. And the last 2 months, that has hit a high of people having more than one job. So people are getting second and third and even fourth jobs, because today versus 2 years ago, the average family, it cost $11,000 a year more. That's almost $1,000 a month in just basic needs that they have to spend today versus 2 years ago. That is a steep, steep increase. And that's a very short period of time to do it in. So you go from, maybe living comfortably to, oh crap, I need a lot more income just to survive. I mean, $1,000 a month for the average person is a lot. I mean, if you're making, I don't know what the average is nationally. It used to be, well, several years ago it was 36. I think it's more like 45 or 50,000 a year. Well, if you're making 50,000 a year, you need 61 now. Take home just to get by on what you were 2 years ago. So it's, you look at numbers like that, and then you see some of the retail is slowing down. There's a lot of factors that when you look at, you start to actually peel the onion back and look at the core, and you see what's beneath the surface. It's not a pretty picture. But the vast majority of people don't do that. They don't dig deeper. They don't ask questions like, why, how does it make any sense that the unemployment rate went down? And they don't recognize and realize that, I think it was last month or the month before, the jobs that were added, 150,000 of them were government jobs, were federal jobs. So the government's hiring a bunch of people. What for? I don't know. They're not private sector jobs, which means those government jobs have to be paid for by your tax revenue. So the private sector's losing jobs, theoretically. I mean, in reality, they are, right? And so all those people that are paying taxes to pay for the federal jobs, it's backwards, basically. So it's just crazy. I'm just catching up on that. Yeah, it is, Brenda. So, yeah, I can see that too. Trips and demographics will cause low unemployment for a few more years. And yeah, I can see that. But yeah, layoffs. I mean, I know the housing sector. I've got friends that are in, loan officers and in title escrow. I know people in that industry, and they've been getting laid off for over a year and a half. I mean, most of them are running skeleton crews, and they're laying off more people because the housing market is extremely slow. It's like 30-year lows for mortgage origination. I think it was 30 or 40-year lows. So the housing market is super slow. Yeah, pay no attention to the man behind the curtain. So again, when it's nice to stand on the beach and look out on the ocean and like, hey, it's beautiful. But if there's an undertow in there and you go swimming, it's not so pretty anymore, is it? So that's really, and again, I'm not trying to be negative Nelly, because the reality is, as traders, we can be in position to take advantage of this kind of opportunity. In fact, in bad economies is where most people actually create wealth. That's where the opportunities lie. If you're prepared for it and ready for it, you know how to take advantage of it, you can actually make more money in a bear market, in a bad market, than you can in a bull market. So again, I know it maybe sounds like on the surface I'm being negative, but in reality, underneath, I'm kind of like chomping at the bit, waiting for it to happen. Because the further it drops, the faster it drops, the more I'll make. And then if you like to own stocks long-term, that's a buying opportunity, right? If things crash, now you can come in. If you've got cash on the sidelines, now you can come in and scoop them up at cheap prices. Especially if it crashes big time, right? So again, I'm always looking for opportunity, and a bear market is an opportunity. Every market is an opportunity. And that's the beauty of trading, is we can take advantage of no matter what opportunities in front of us. But today, really what I want to kind of focus on is if the bear shows up, right? What happens if Black Swan swells up, which I'm getting a little ahead of myself, but I just saw this yesterday, which adds another piece of the puzzle to the bear case. Unrealized gains and losses on investment securities. So this is what banks own. Down at the bottom, you see FDIC on Wednesday released its third quarter update on the state of the nation's banks, showing growing theoretical losses. They are theoretical at this point. But what happens if they have to realize? What happens if people start to pull their money out? Exactly what happened to SVB and whatever the other two were, is there is a pretty decent likelihood that that's going to happen to another bank, if not lots of more banks. Because when you go out and buy a boatload of 30-year bonds that are paying 2 and 3%, maybe 4%, you pay $100 for that bond, and then interest rates go up to 6, 7, 8%. Why would anybody come in and buy your bond for $100 when they can go buy a bond for $100? It's going to get 3 times the rate of return. So your $100 valuation just dropped to 80, 70, 60. So your bonds are worth a lot less. Notice that is $600 billion. So they are upside down in a big, big way, which again, it's some of you may have experienced this back in 2000, 2008. And I remember we had a house at the time, and I tried to convince the ex-wife to sell it in 2008. I was like, look, this market's not going to stay up here. I mean, we had $100,000 of equity in 3 years. And that was at that time, the house was only $250. Now they're double that. But it was like the neighbor bought their house for $350, and it was almost the same thing as what we had. It was about the same size. And I mean, it was very similar. If we can sell for $350, we can bank 60, 70, 80 grand. Let's go rent a place for a couple of years. And then if the market cools off, which I think it's going to, we'll come in and buy something. No. Of course, I got shot down, but whatever. So we ended up eating $15,000 a year and a half later. So that $100,000 of equity not only went away, but we were upside down. So in 5 years, we actually lost 15 grand instead of gaining 70, 80, 90. 100 gross, right? But so if you had a mortgage back then and you bought the house high at 350, and my neighbors were hating it because they were upside down 100 grand. If you bought it at 350 and it's now at 250, what are you going to do? What happens if you need cash? What happens if you have to sell that house and you don't have the $100,000 to cover it? I mean, you'll remember the short sale market in what, 09, 08, 09, 2010, 2011. It lasted for quite a while. That's what people did. They just walked away. They said, you can't do it. Well, it's not any different situation for the banks. They are wildly upside down. And if they need the cash and they can't raise it, they have no choice. Their doors get shut. FDIC will come in and shut them down. So there is a very real risk that another bank at some point, a big bank, possibly could go under. When and where it's coming from, who knows? Because SVB kind of came out of the blue, at least for most people. I mean, it wasn't on my radar. I wasn't paying attention to the banking sector and whether or not it would. I'm sure there were people that did. But it's one of those things that kind of blindsides you, right? Yeah, if we don't realize it. More cost accounting. Well, I think the Fed's come out and said that they will. I think they're doing something where they're buying them back. I can't remember what it was. They created some new program where they'll buy them at full price, is what they've said. I think it was. So if the bonds were $60, they'll pay the bank $100 for it. So the Fed's going to hang on to that paper for another 25, 28 years and collect 2 or 3% interest rate with our money. Well, wait, the Fed's private, so it's their money. Whose is it? Definitely not theirs. So, yeah, I see that. The government's requiring banks to have more capital, which isn't a bad thing, kind of. I honestly wish the government would just get out of banking and stop with all the regulations and all the other junk. But because in the old days, they didn't have the government regulators weren't there. There was no FDIC. So when you went to a bank, you asked a lot of questions. You know, you wanted to protect your own money. Now people just throw money at a bank because they don't care. It's like, hey, it's FDA insured. Who cares? I'll get my money back if they fail. So it doesn't matter. So it's a lot more willy-nilly. Where in the old days, people actually cared about their money and they'd go talk to the bank. What are you guys investing in? Let me see the books. And the banks would open the books and show them what they're investing in. People had to protect themselves. They didn't have some government agency to back their butt up. So exactly. Ultimately, it gets amortized over the entire base of taxpayers. Because when a bank like SVB fails, basically the government, the Fed, or Uncle Sam will step in and cover it, which is what they did in all 3 of those cases. So you and I subsidized the bank failure, which is like a child throwing a fit at the store because they want a candy bar, and you give it and let them get the candy bar. They scream and yell and make a scene, so you give in to them, What are they going to do? The next time you go to the store, they're going to scream and yell because they know you're going to give in. So banks are going to go out and take unnecessary risks. Why should we worry? The Fed's going to come in and save us. Let's take these wild and crazy risks, because if they pay off, then they get big bonuses, right? Why not? Uncle Sam will save us. I should take risks. So it's unfortunate. And I think it'd be good if most of the regulators disappeared and most of the regulations disappeared. I mean, I don't think all regulation is bad. I think some needs to be there. But unfortunately, it's so cumbersome that it's gross. And now, I mean, banks are going to send out about 30 million more 1099Ks this year, because if you had a side business, and I was just talking to a lady about this the other day, she and her mom do garage sales, and she had no idea. I was like, you taking money through Venmo and PayPal and all that stuff? Yeah, you're going to get hit with a 1099K this year. Because I asked, I said, did you do more than $600 a business? Yeah, you're going to have a 1099K. You're going to owe tax on that. I mean, you're going to have to pay Uncle Sam. They're going to know about it. Let's put it that way. Last year it was 20 or 22,000. So now if you have a little side business where you're making $1,000, $1,200, $1,500 a year, why would you keep doing it if Uncle Sam's going to take the money? Or why would you use that? Everybody's just going to switch to doing cash. They're going to stop using Venmo. Companies like that are making money off of that, I would imagine they'll survive, but why would you continue to take Venmo if Uncle Sam's going to know about it? Not going to. And honestly, I think that is going to be a major drag on the economy next year. Why would you? I mean, people are still going to do Uber and all that stuff, right? If you're doing it as a side biz. But why would you keep it if you're just doing a little bit? You know what I mean? So I think a lot of people next year are going to start to rethink. Once they see the 1099K, they're going to go, wait a minute. I don't know how big of an effect it'll have on the economy. It may or may not be a big deal. There'll be a lot of angry people. I know that. But there's the big question. If the black swan appears, what happens, right? You all know what a black swan is, I assume, right? A one-time event. COVID was a black swan. Something you don't expect, you don't know is coming, and it creates a massive sell-off in the market. It creates a panic, right? That's what COVID did. So you all know what a black swan is. If you haven't heard the term, that's what it is. There's a good book. It's I can't remember the title of it. I've got it somewhere here. It might just be Black Swan. But it's a great book. I read it years ago. I probably should reread it, but the question becomes, how do you protect against that? What if it's coming and we don't know when it's going to appear, right? You don't know when it's going to fly overhead and go, uh-oh, just like COVID, right? Most people, I did talk to a gentleman that was a portfolio manager. He was expecting it. He actually got all of his clients out of the way before it hit, which was great. But then it bounced back and he didn't expect that. And so they left a bunch of money on the table. And I was like, yeah, I understand that because I didn't expect it either. So, but so if you own stock, if you have a retirement account, how do you make sure that you don't get hit? Because if you did hold stocks through COVID, if you have a retirement account, an IRA, 401k, it wasn't pretty. I know my brother was freaking out. He does his own style. He was just panicking. He's like, he held through it and he's glad he did. He's not a trader. He's a long-term investor and he does his own thing and we don't even talk about it. I don't care. And like whatever. And it's different. You know, if you're doing long-term investing, it's different than what I'm doing. So my opinion and my perspective doesn't mean much to him, and he doesn't like to hear the bearish story. He thinks he's the one that calls me a negative Nelly. You're always so negative. You always think the market's going to crash. It's like, oh, it's going to at some point. So the question is, are you prepared for it? So if you own stock, what do you do? Right? You could sell your stock. You could just get completely out of the way, which if you happen to know for some reason that it's coming, anybody here in Congress? Right? That's sad. But you can completely get out of the way. But if you've had the stocks for a long time and they're in a taxable account, then you may have a taxable event. So you got to obviously account for that. So I've never heard it put that way, Trip, but I like it. Flat is a strategy. Flat meaning having no positions. And I have employed that strategy a few times. I just never thought about it like that. So I like that though. So yeah, you can get flat. You could just sell everything. And actually, I think there is the possibility, and that makes me think that with technology today, and I've been saying this for 2 or 3 years, that if we have a crash like we had the COVID crash now, and I'm sure that happened to it. I mean, it was part of it. You can literally go, I mean, I can go on toss right now in all of my positions. I can just hit flatten or close all or something like that. I've never planned on using it, but you can literally just close every single position you have in one fell swoop. So if somebody's got a portfolio of a whole bunch of people go and do that, which the odds are that most people won't, but it is possible if people just start to panic and freak out, like just get rid of everything. But the question ultimately becomes, what if you want to keep it? What if you have stock you own, well, you don't want to pay tax on for whatever reason, or you want to hang on to it? You think long-term, the company, you like the company, it's going to go up, even though it may go down short-term. Obviously, you can buy insurance, right? Puts. You can protect yourself against those. You can sell calls against it, which there is a risk it gets taken away if you don't account for that risk, right? You can fix that. If you sell a call against the stock, if it's at a resistance, you put a stop above the resistance and buy it back. Right? You sell a call for $3. If it goes above your resistance level, it goes higher. You don't want to get called away. You put a stop order in it, $4, and you buy it back for $4. I mean, you lost $1, but it's better than losing the stock if you don't want to lose the stock, right? Or one thing I've shown, I don't remember if it was here or if it was Trade You, but what you can do, and it's one thing I like if I own stock, which I don't. I have a couple short ETFs, but and that's, I'm waiting for the Black Swan event, which actually is one way you could realistically hedge against it instead of buying puts. If you don't want to do options, which is fine. But one thing you can do with selling calls is if you're a decent trader, right, and you find a resistance, like I was talking about, if you sell a call at resistance on the stock and it drops, the value of that call goes down. You sell it out of the money call for $3. And if it goes down and you wait the whole month and let it expire worthless, you collected $3, right? Your stock's at resistance. And instead of selling an out of the money call, you sell a slightly in the money call, or maybe a little bit deeper. But you can't go too deep. If you go too deep, you got the chance of it getting called away. You sell it in the money call, expecting that it's going to drop, and maybe say you get $6 for it. If the stock drops like you expect it to in the next few days or a week or two, and you can buy it back for $3, you collected $6, you paid $3, you still made that same $3, but you did it in a shorter time frame. You did maybe a week or two instead of waiting a whole month to collect it. Obviously, there's risks on both sides of that. If it goes up, you'd have to stop out of it, same as you would if you sold the threes, right? So you might take a little bit bigger hit. But it's a way to protect your stock, the downside of your stock, or if the stock is trending lower over a longer term period, you can collect money. Every time it rallies, you sell a rally, right? Just like buy the dip. In a bull market, you buy the dip. Bear market, you sell the rally. So if a bear market comes and the stock rallies up and you own it, it rallies up, it hits a resistance, it gets exhausted to the upside. It looks like it's going to fall. Boom, you go sell a slightly in the money call. It drops off, lowers down, and now you collect a bigger premium than you would have if you sell in the out of the money calls. It's a way to protect the downside, right? Instead collecting $6 instead of $3. And what if it drops below the strike price you sold? I mean, you could theoretically leave it there. You could realistically just trail it down. Let me shut that off. You could just trail the option down and let it take you out. I mean, there's a million different ways to go about it, right? There's no set way to do it. So there's lots of different ways you could. I'm just throwing ideas on the table, and obviously you have to decide for yourself what works for you. Callers is another way to do it, right? You sell the call. You can sell whatever call you want. You sell the calls and you buy the puts. You use the capital that you sold the calls with to buy the puts. That is if you have the opinion that the market is going to drop big and quickly, that I think is the best option, especially if you're trying to protect your stocks. So, but here's another idea I'm going to throw out there. And it is a full bearish move. What if you did the opposite of a covered call? What if you shorted the stock and then sold an out of the money put? So it would be below it, right? And then you buy a call. You do an inverted collar, upside down, whatever you want to call it. I don't know. It's something I thought about years ago, and I went, it's interesting. If we're headed into a bear market and you own stock, then your stocks go down in value. But what if you short a stock? Then it goes down and you obviously make a profit. You short something at 50, it goes to 30, you've made 20 bucks. But what if you shorted it at 50? You buy a 55 call and you sell a $45 put. You short the stock at 50, if it drops below 45, because when you sell a put, y'all are probably familiar with selling put strategy, right? Well, the stock might get put to me. I might be forced to buy it at 45. Okay, well, I sold it short at 50. And if I'm forced to buy it at 45, I put 50 bucks in my pocket to begin with. I gave them back 45. I still have $5 left in my pocket. You made $5. That's 10% on 50. It's actually 20% because you only have to put up half for a short position, right? So it's 25 bucks. You made $5. You made 20%. And then you buy the call. See, this is one. A caller on owning stock is optional. I think if you short the stock and you sell a put, I think buying a call, because obviously a short has unlimited. If a stock takes off, if you get what's the AMC situation, right? If the stock takes off to the upside, you should have some protection, because a short can continue to run forever. And companies, literally, hedge funds went bankrupt because of AMC. So you don't want to put yourself in that position. So I would, if I was going to do that, if I'm going to short the stock, sell a put below it, I would definitely be using the proceeds from the put to buy a call as a crazy protection. So yeah, it's just an upside down collar trip. Actually, I was gonna mention it to you because I thought you might want to look at adding that to your stuff. It's something I thought, like I said, I've thought about it years ago, and I've talked about it once or twice, but it just hit my brain the other day, and I'm like, you know what? And this market is pretty extended right now. So if you get into a market situation like we have now, where it's up a bunch, and the odds are higher that it's going to drop before it goes up. I mean, it could have another rally. We could go up and hit all-time highs if this momentum keeps up for a little while longer. But I don't think long-term it's going to stay up here. So anytime a market gets extended, you look at it and go, and so now that's possibly, you could throw that strategy in and go, okay, in my retirement account, maybe I want to do this. If you can. A retirement account's a little more challenging to short and do that kind of stuff. But if you have your, a regular account you trade in, that's one thought that you might want to do is go, let me short the stock, or even just not even sell the put, short the stock and just buy a call and hang on to it. I mean, it'd be the same as buying a put. It costs more money. Buying a put obviously is going to give you more leverage because it's less expensive. You short a $50 stock, you can buy a put for $5. That's personally what I do. But again, I'm just throwing ideas out there, something to think about. Because if a bear market does show up and you're short the stock and things collapse and it crashes, then obviously you make a killing. So, but if you're into the covered calls and you like that type of stuff, that's just one thing that you could do. One other thing you could do that I forgot to even put on here is look for short ETFs. If this isn't a retirement account and you don't have the ability to do options, you don't have the ability to short stock, but you own stock and you want to protect it from the downside. This is the beauty of ETFs, especially if you don't like options. Short ETFs. So this is the SQQQ. Not yours, Brenda. Put an S in front of it. So it's a short QQQ. So this is an ETF that shorts all the NASDAQ stocks. So all the stocks that are in the Qs are in here, but they're short. So it literally goes the opposite of the market. And you can see the big rally we've had, right? Actually, we had a nice ascending triangle. It busted out for a couple of days and then fell back and the market went crazy rallied. So this thing dropped. So if you own a bunch of NASDAQ stocks, and you can see, and these are essentially designed for hedging to protect yourself. So that if the market crashes, you can own this, right? And you can see the crazy price that it used to be at. How far back it goes. What is that, weeklies? Nope, let's get weeklies. So yeah, these were created back in, I mean, ETFs are still relatively new. The Qs and the spiders were only created, what, in the late 90s, I think? Early 2000? I mean, they were fairly new when I started back in 2000. But it's crazy. You can see it started at 450,000. And that looks like a terrible chart, right? Which it is. When the market is bullish, this is what it looks like. We could also see lots of splits. Watch this. If we unadjust it for splits, there's all the splits. So they short it and then they'll split it, right? And this is stocks about 10. They did, it looks like a 6-to-1 or a 1-for-6 split. So this is not something it's not something you buy as a long-term hold. This is more designed for hedging. So if you have a portfolio of technology stocks, or if you own the Qs and you believe the Qs are going down, or maybe you don't like options, maybe you don't like the time value of options, but you want to trade the bearish side of the market, maybe you haven't shorted, maybe you're not familiar with puts yet, maybe you don't understand them, they're hard to grasp when you're starting, right? So this is one option. You say, okay, I'm bearish on the market, which actually will make this one bullish. I don't know where. And that pattern's been negated, so we'll get rid of that. Yeah, well, this was all-time lows for it. So a couple different choices. I mean, right? You could just trade this if you think the market's going to drop, or like I said, if you have a position, and this is not the only one. There is it SRTY? I think it is. Yeah, there's the Russell. So if you want to be short the Russell, you can go long this, right? So they have lots of ETFs that are shorting these specific indexes. And so they go the opposite. They watch if we do a comparison overlay, RUT. Exact opposite. Whoops. Well, that's kind of excuse it. Well, you can see, actually, this is a perfect example. Here's the COVID crash, right? In purple, that is the Russell. This purple line is the Russell, and this black line is the short Russell. So you can see in a market crash what happens with the short Russell. And this thing went from, I don't know what split adjusted is, but we'll just look at, okay, it was 500. It went to 1,300. So it was 250 to 300% when the market crashed. So if you owned the Russell, or if you owned the spiders, if you own anything, any stocks, you were getting hammered here. If you also owned some of this short ETF, then you're not getting hammered quite as bad. You're probably still going to be upside down, but you're not going to lose your shirt. You're going to have a hedge. So that's one way to do it too. I can't remember what is the spiders one. I don't think it's SPY, is it? I mean, you get the gist though, right? So if we have a massive crash coming, that's one way to hedge. Maybe you just pick up a little bit. If you got $250,000 retirement account, go buy $10,000 worth of this, whatever the numbers work for you, right? To protect yourself. So, and some of these are optionable. I don't know if this is or not. Let's see, where'd to go? I thought I had, yep, I did. There we go. SRTY. Curious. Yeah, they do have options. So you could realistically buy one of these and sell calls against it. Let's see what they have though. January is 42 days out. See if there's any, if you're selling, it doesn't matter, but. So it's basically at $40. So at the monies are 40. It's not bad actually for 42 days. It's $260 on a $40 stock. Of course, if this takes off to the upside, if you're buying it as a hedge, wow, that's moving quick. If you're buying it as a hedge, then you may not want to get rid of it, right? If it goes up, then that means the market's going down. So obviously you have to account for that, but $5 is low on that. Okay, so it's not quite there, but close. But I think you get the gist, right? The point is that find a way, if you're a bear like I am, if you think that this market is possibly going to have a big crash, which I think it's more likely than it's not. Oh, and the SQQQ. Okay, that's what I thought. But yeah, you want to make sure and cover your backside. And the beauty is if you hedge, if you go buy some of those short ETFs, or you buy puts, or you decide to do covered calls, and you do the shorter term instead of waiting for a month, maybe you do a short, in the money, and you buy it back within 3 days. You set up whatever rules you want for how to do it, and you cash flow it if it's trending lower, right? Trying to think of a stock that I know that's been trending lower. The beauty is that if we do have a crash, then you can cash out your profits on the other ones and take that profit and go buy more of the stocks that you like. If you're looking to accumulate a long-term portfolio of stocks that you like, that you think are going to be higher in 10 or 20 or 30 years, then you take the profits you made from your hedging and redeploy it into those stocks. Well, there's one, Chevron. Actually, this is one that I'm sure a lot of people own, or General Mills is actually better. These guys have been, I don't know what happened here. All the food companies just got destroyed from the beginning of summer to the end of summer. 88 down to 60, that's, 90, that's 30 something, that's 50% almost, 30%. So if you own the stock and you were selling puts along this, then yeah, instead of losing, $38 in value, if you captured, 5 or 10 or 15, maybe $20 of that in call premium, when it pops up like this, sell the rally. Of course, here you don't know yet. We really don't even know yet here that it's going to keep going. You would expect that it would dig in and hold that level, but you could realistically do, I'm a breakout trader, right? You could just wait for breakouts and say, what, if it's, here it rallied back up after a pretty decent little sell-off, there's still no indication it's going to keep going. But you get into this situation, you're going, okay, we got a bearish engulfing pattern here. And this is a spot you go, well, we've been dropping and we might keep going. We're at $80. Maybe you sell the 78s or the 75s. And if you did it anywhere in here, you're pretty happy this day, right? Right? It's a big if, right? It's always woulda, shoulda, coulda. And it's easy to look back historically and say, well, if you would have just sold right here at the very high, the high is 81.18. If you would have sold that stock at 81.18, you would have made a fortune. Woulda, shoulda, coulda, right? I just realized that. So because I've had that happen once, right? Back in 2001, I was a broker, and this guy I was working with, he said, hey, there's an opportunity to go trade. They're going to give you $300,000 to trade with. You just have to do it their way. You have to go down 6 weeks in Vegas and trade. I'm like, they're going to give me 300,000 and we split the profits 50-50. Okay. Well, when I got there, it was an interesting trading strategy, and I started to tweak it and make it my own. And I remember Fannie Mae, they're not really around anymore. At least I don't think they're public anymore. If they are, I'd be surprised. But I remember it was running up, and there was a resistance right at 69. It was a round number, resistance right at 69. So I threw an order out there for 1,000 shares at 69. It went up and hit that order and then turned and dropped quickly. And for a couple of years, I'd go back and look at the chart and be like, that's me. You see that high right there? That tick right there, right at exactly $69, and go, that was me. It's happened once out of, I don't know how many millions of shares I traded and option trades. And the other day I was talking about AEM, because I got into AEM, right, as it broke north here when gold started to take off, right? I jumped in there, sold out, not quite half of it up here. It triggered it like, I don't know, 40 or 50% gain. And then a couple of days later, this day right here, it had pulled back and it was holding this line. And I had an order below the market to re-enter the trade. Okay, if it comes down in this area, I think it's going to hold that. And it literally came down and triggered my order and then turned and rallied up. That was an options trade, so there's a little bit of flexibility, right? I didn't hit stock, I hit an option, so it's not exact. But I was kind of sort of jokingly bragging how I may have hit the bottom again. But see, this is what happens sometimes though too. And now I'm not even close. Right now I'm actually upside down on that position that I re-entered. I'm still about break even on the one that I got in here. But I'm upside down on the re-entry because I expected we would keep going north, which this thing could turn around pretty easily. We'll see what it all depends on what gold does, right? So hitting the exact top or bottom is extremely rare. It's once, maybe a 2 or 3 time in a lifetime event. Because I still, now that this thing's down, if it would have kept going, I could have said, yeah, I hit the bottom or really close. But obviously that's been destroyed. So that would be number 2 in almost 24 years now. So it doesn't happen very often. Don't expect it. It's very rare. So any of y'all have any stocks you want to look at? We got about 15 minutes left. Whether we just want to analyze it, talk about potential ways to, I know that was a stupid question, huh, Brenda? I should have known. Do you trade anything but those? That's not bad. I mean, if you find something that works. Oh, I should have known that too. If you find something that works for you, then stick to it. That's why I trade the way I do. You know, and it's I've gone down every alley and tried every strategy and done everything that there is. All right, see you, Kevin. You too. Have a good weekend. Once you find something that works for you, then there's no reason to deviate from it, right? Once you find the strategy and the trading style that fits your personality and your risk tolerance and all your different factors that you're considering, then stick with it. So, Brenda, if you got something that works, if you're just trading the spiders and Qs and it works for you, keep doing it. That's all that matters. Find what works for you and stick to it. That will never end, Brenda. Still tweaking. You're always going to be tweaking things. I'm still tweaking things little by little. You know, it's that little bit of edge. So no matter how long you're at this, you know, you're always looking for a little bit of an edge. And if you can add another edge that will give you another edge, then now you have a double edge. Interesting. That is I look at the SPX and then, you know, I look at the major market indexes. Maybe I should look at these more frequently because the volume on this is accurate. The volume on the SPX, and for whatever reason, the indexes have the volume's a little bit tweaked on it. I don't know if it's a data thing or what, but it just doesn't look right. Whoops. So yeah, we've got that resistance there about 460, but that is we keep trying to hit this spot and it keeps trying. That is today. It's a little bit, it's about 15 minutes delayed. That last candle is today's. Excuse me. But do you see what I see? It might mean nothing, but it might mean everything. The volume, look at the volume on the spiders. And this, I mean, this rally honestly took me by surprise. I'm stunned at how far and how fast it's gone. It didn't make sense. We had a beautiful head and shoulders right here. I don't know how many of y'all can see that, but if you couldn't see it, you need patterns of flash. I'll just put it that way. I'm just going to be blunt. All 4 major markets were doing the exact same thing. And that's exactly what we had in 2008. Before the crash, all 4, SPX, Dow, NASDAQ, Russell. All 4 of those markets were in a head and shoulders pattern. Right at the same time. And if you go back to 2008, I showed this a couple of months ago when before this even broke, actually, it was somewhere right in here as it started to form the head and shoulders. I said, here we go. This might just be the very end of it. And of course, I mean, those that understand these patterns is there's the measured move and it actually played out beautifully. It didn't make it on the first run, but it rallied up a few more days and then came down and found the support level. But it definitely, the measured move is what we made it that far and a little bit beyond it. So the pattern itself played out. But then you've got lower highs, lower lows, everything about it's looking good, expecting that this thing's going to keep going lower. We're starting into the new bear market, right? We've had a sideways market for the most part this year. And here we go. And then Fed came out and everybody got all excited, like, oh, he's done cutting rates. The pivot's here. Everybody's talking about the pivot. Not everybody, but a lot of people are saying, well, when the Fed pivots, when the Fed stops raising rates, that's when the markets turn. And there is some historical data that shows that. If you go back and look at, I think it was after the housing crash in 2008, when the Fed started, when he pivoted, right? The housing market crashed. Rates had gone up. I don't remember all the details, but when the Fed started to cut rates is when the market bottomed and turned around and started going north. And there's several times that's happened. And so people point to that and say, well, look, when the Fed pivots, that's the time to buy. Well, this, at least from what I can see, the market went, hey, the Fed's pivoting. The Fed decided to stop raising rates. They're not cutting rates. They're just stopping raising. And people perceive that as a pivot. Okay. And a lot of it was short covering. I mean, if you got short up here, and this is where I think it's important mentally to get into a position to understand both sides of the market. If you're not familiar with shorting, get familiar with it and start shorting stocks on paper, just for fun to see how things work. Because if you shorted a stock, if you get, here's an evening star right up here on the spiders, then you get a big bearish engulfing pattern at a resistance level at 460 there, and then it drops. If you shorted the stock up in here, you said, hey, we got an evening star and a bearish engulfing pattern, two big giant bearish reversal patterns right at a resistance level, I'm going to short this thing. You shorted at 450, it comes down to 435. What are you going to do? I mean, you got 25 bucks of profit. 25 on 45 is 450 is what, whatever that is percentage wise, 2 or 3%. But when you short, obviously you're not buying something, so you have to short on margin. So realistically, your margin requirement is only half. So you're talking 225, 230, 230 bucks a share of margin requirement. You made 25, that's 10%. You made 10% in a month. What are you going to do? You're probably going to at least take some profit, right? So these kinds of rallies, a lot of times are short covering rallies. Because if you shorted up here and you're up 10% in a month, you cover your short. And what happens when you cover your short? You're buying. So that creates buying pressure. So maybe you short it somewhere in this area. It comes down, you're up 10%. Like, hey, cool, I'll take my profit. It runs back up here. Sell the rallies, right? If you're in bear mode, if you're bear and you're shorting the market, sell the rallies. Boom, it rallied. Start shorting it again somewhere in here. Anywhere in here, right? You start to see signals. You go, okay, I'm going to take a short position again. And then it does this, 455 down to 420. That's another 10, 15%. Cover my shorts. Boom, buying. So all the traders that got short up in here are now buying, which creates this little rally. And then they start shorting again because you got the previous support here. You got the window that's open right there, which actually this was a fun run. This is one thing I remember showing is not only do you have that open window, but the previous support right in there. So you've got this heavy spot of resistance. The market crashed right through it. It gapped through it. That window is probably to act like resistance. It started dancing up here. You got a hangman. You got a long shadow. You got a bearish engulfing pattern. Another long shadow. It tried, it failed, and it gaps down and takes off. That was 4 or 5 days of indication that said the bulls have run it up, but they're getting tired. And then it comes down here. This was beautiful. And then all of a sudden, news comes out and people are like, oh, here we go. And shorts covered and people started buying. Money came in and it created this massive momentum up to the upside. But yeah, look at where we're at now. Okay. And this is, you can see the time here. It says 9:39 right there. It's actually 9:54. This is about 15 minutes delayed, right? So it's streaming, but it's not real time, if you know what I mean. So it's close. It's 4:58. Where is it actually at? It should be 4:59. 45.92 is where the SPX is at right now at this second. So it's pretty close. But this right here, the volume dropping off, especially you look at the slope of the average, right? That's the moving average of the volume. So a bullish run like this on light volume is actually bearish. The price is bullish, but the bulls are not that excited about it. There's not many people showing, there's not many bulls showing up to the party. And the bears are just waiting outside going, okay, as soon as the bulls start to leave the party, we're going to crash it. So they're waiting outside in the street, hanging out in their cars, watching to see the bulls start to exit the door. As soon as the bulls start to come out, they're like, the bulls are done. The party's over. Let's go crash it. So then again, it could mean nothing. It could just mean that the bulls have decided to slow down and say, you know what, we're not going to buy here yet, but if it breaks north, we'll jump on and buy some more. That's possible. I think it's more likely that this is an indication, a pretty glaring indication, because it doesn't usually drop that fast. If we go back and look, well, that's what's funny is see back here, it did the same thing, sideways move. We didn't have this massive bull. This was a nice little bullish move to the upside. right? We had a big sell-off. Looks almost like capitulation. Get a little more time there. So yeah, we had a big sell-off, and it started to rally, and it went sideways. After this little rally, the volume started to drop off, very similar to it did here. And actually, that preceded a big rally like this. So that's possible. Oh, that's right. There's the inverted head and shoulders. It was there. But we had been beat down for a year and a half, 2 years. So that kind of sort of makes sense. Up here, we're super extended, which it could. It very well could happen again and break north like that, just like it did here, and have another rally to the upside. We hit the all-time high. I wouldn't be shocked. But I think with, what the heck? Something weird just happened. I think with the speed of this move, I think the odds are higher that we have some kind of pullback. And this is an odds business. It's about putting the odds on your side. So that's one thing I'm always weighing, is looking at the chart and going, okay, back then, the odds of it rallying were probably about the same because we had been beat down for so long. We were already pretty low. So it was probably a 50-50 chance of it breaking down versus breaking up. Here, we're super extended. We're near an all-time high. And that was, no, there's no, I was wondering if there's some kind of holiday that affected the volume, but there wasn't. So we'll see. We don't know. That's the hard part. It's always a coin flip. There's no way to know for certain. All we can do is analyze it and say, okay, here's what it looks like. Here's what the odds are, in my opinion. And I'm going to prepare for that. If it breaks to the upside, okay, then that's weird. Then, take a ride to the upside. Might be short-lived, might be quick, but, if you can make a profit, make a profit. If it drops from here, take advantage of it, right? We're kind of in that that space where it could go either way. I'm just of the opinion that we're more likely to head south. Qs are going to be similar picture. And you can see, again, same thing, volume's dropping off. So the bulls are not that excited about it right here. Could that change and they come in and get excited about it? Yeah. And actually now it's done that. There's an even more indication of bearishness right there. Megaphone, some people call it. It's a broadening pattern is what it's technically called. And it is an indication of a top typically, because the volatility swings are getting more and more violent, more and more crazy. Excuse me. And when this happens, right, you got the bulls push up, the bears push it down, right? The bulls made a new high here. They come back down and the bears make a new low, or intraday they do here. Then the bulls come up. They didn't quite. Actually, there was a nice looking downtrend started. So we actually had a downtrend. That's why I was expecting it to continue to fall, right? We got a nice lower highs, lower lows. Let me make it bigger. Sorry, Brenda. Right? You got bulls making a new high. They pull it down. We got a new low, a lower high, lower low just by a little bit, lower high, lower low. Everything was setting up for the market to continue to drop. But then volatility came in and news came in, boom, blasted it all the way up. And now the bulls make a new high. They busted right through that. And okay. So the swings, this is not a great example, but there are a lot. I don't know if I have time to do this. Let's see if we can find one real quick. There's kind of an example, but see if we can find a good example of one. There's a bunch in here. And this is my list I go through. I went through it yesterday, 316 stocks. There's a lot of them in here. I just saw your note, Trev. Yeah. Yeah, wait until deflation starts. Yeah. People think deflation is good, and it's not. It's actually the opposite. It's probably, it can be worse than inflation. But there are quite a few. And when you go through 315, this is one of the reasons I trade the way I do, is there's one right there. That's AMAT, right? Get rid of all that. So the bulls keep making higher highs and the bears come back and make lower lows. It's an increase in volatility, right? The swings get bigger and larger, which is usually an indication of a peak. AMD, that's part of it too. You got news, a lot of it's news driven, right? There's one right there. There's Amazon. That's a pretty dramatic broadening pattern. The swings get more and more wild. And so it's like watching the tug of war match where they just keep, it's like, woo, they almost pulled the whole bull crew in the pit. And then all of a sudden it's like, whoa, it goes the other way. Right. And then the bear crew's almost in the pit. And it just, you've all seen that type of thing, or, a football game where it goes back and forth. And it's just, and in trading, it's there's a giant one actually. That's pretty crazy. Right. I don't know if it's going to show up on there or not, but it's oh, that's Boeing. And this is what blows my mind is, just 2 or 3 months ago, these stocks are getting destroyed, getting pushed down. Right. And this was a beautiful trade. They're getting pushed lower. And then all of a sudden we're, 2 or 3 months later, we're all the way back at the highs. Did things really change? If everybody thought the stock stunk here at $200, it's not even good at $200. Let's sell it. And now all of a sudden, just 2 or 3 months later, it's all of a sudden worth $242. The economy doesn't change that quickly. It just doesn't. So what changed here? Why? And this is not uncommon right now. There's a lot of those, a lot of stocks this has happened to, where they've just gone crazy to the upside, and it's rallying today. And this could be a result of the war. They're probably getting a lot of business due to that, which war can be very bullish for the market, which stinks, but it is what it is. So I know there's a lot more in here, but when you look through 300 stocks, there's probably 20 or 30 of them in here that are all forming broadening patterns. And you got Amazon, the big one, Boeing's a big one. So we've got to take those things into account. When you see a lot of them, it's kind of a big clue. And then oh shoot, almost forgot you, Trip. Sorry. So beyond that, be on guard, because there's a lot of iffy things going on, and things that could very easily make this market just collapse at any time. If a big bank was to collapse, this market's going to sell off quick. And there's so many different things that are right there that I think it's wise, if you have a portfolio of stocks, to do something to protect against a downside move. Because again, you don't know when it's coming or how quick it could be. So figure out a way for yourself to mitigate the risk and protect yourself as much as possible. Yeah, this is just climbing a cliff. We're all-time highs here. Which is, when you look at last earnings season, there's some companies came out and had killer earnings, and other companies got just destroyed. So there's kind of this mix. Usually in a bull market, when things are really this bullish, every company is out doing well. Almost every company, the majority of them are. And from what I've seen last earnings season, it was a mixed bag. And it's been a mixed bag for the last 3 or 4 or 5 earnings seasons, the last year or two. Some companies are doing spectacular, others are not. Some of them are driven by the AI craze. And honestly, I think AI is the new .com. I think it will be great technology, but I think people are too early. They're jumping on and driving these things higher, expecting that AI is going to be the next savior, and it's going to create the next bull market, the next bull cycle. And it might. I just think it's too early, just like .com. What was that? Webvan. I just found that a month or so ago. That's the company that was going to deliver groceries, right? They built the website. And you know what? They were 20 years too early, because that's happening now. People, you can buy groceries online, but the internet and the web was not powerful enough to really drive that. People didn't have cell phones. We did, but they weren't like they are now, right? They were 20 years too early. If that company would have been started 10 years ago, they probably would have succeeded. But they started too early. They got ahead of it. I'd see AI as that right now. I don't see anything on IBM right now. I think it's probably overdone. I wouldn't do anything with it here myself, because I'm a breakout trader, right? I'm looking for a support or resistance level, some kind of pattern. I don't even see any. You got a little bearish engulfing pattern there, a little tiny one, but not a lot of volume. So I don't see any signal here, any indication that says it's time to get in, either bullish or bearish. I wouldn't be bullish on it because it's too far extended. I would actually expect it to pull back to here myself. But if the market rallies, it could take another leg to the upside. Who knows? I just think this is overdone myself. So if you do buy puts, it would be a somewhat risky, unless there's some other kind of indication. But then again, the stop's not that far away. If you're going off the high of that, high is what, 162.79. So if you just say, you know what, I'm going to stop out if it breaks the high, we'll look for it to break down, come back down to 150 or so. 149. I mean, I wouldn't do this myself because there's no clear signal except for that little bearish engulfing. But if you have an appetite for a little bit of risk, I think the odds are better this thing's going to drop back down than it is continuing to run. So if you tip the scales, I would be more bearish on this than bullish for sure. But that's me. So what if you have funds inside this? I got to end with this question. I just realized I'm a little over. Bullish engulfing where? Give me a sec, Gwen. You mean today? Yes and no. The pattern itself it's not technically a bullish engulfing because a bullish engulfing pattern comes after a downward move. This is a sideways move. So it depends on how OCD you want to get about it. I sometimes get OCD, but yeah, I mean, and there's a bearish engulfing pattern. That bearish engulfing pattern here 3 days ago is bearish engulfing because it's after a run, right? After a sideways move or a rally, it's not technically like this is not a bullish engulfing pattern here, right? For sure, this day engulfed the previous day, but technically a bullish engulfing pattern has to be like here. You got a 2 or 3 day move. This is a bullish engulfing pattern. So, yeah, I don't consider that a bullish engulfing pattern because I am a little OCD. Like back to you, Gwen. Sorry. What if you have funds inside a brokerage that's not committed to any stocks? It depends on what they're invested in. If you're talking mutual funds they're maybe not committed to any specific stock, but are they invested into equities, or are they into bonds, or it's nothing? It's just in cash. Oh well, yeah, cash is safe from a crash. It's not safe from inflation, but it's safe from a crash. Yeah. So if you're in cash, then you have all kinds of different options you could do. And obviously I can't tell you what you should or shouldn't do, but I mean, and that's the point of this, is throwing ideas on the table. But yeah, if you're just sitting in cash, I don't think that's a bad place to be. You could wait if you don't like shorting. If you don't want to play the downside of the market, if you're not familiar with it, if you're not familiar with shorting, and you may or may not be able to, depending on what kind of account it is, right? If it's a retirement account, you have limitations on what you can and can't do. So there's lots of rules and regs based on that. But yeah, if you're just sitting in cash, if you want to buy stocks long term, some people are buying right now, and I think they're crazy myself, because I think, in my opinion, you wait till there's blood in the streets. If you're sitting on cash and you want to buy stocks for a long-term hold, wait for the market to crash, which could be a few months. It could be a year or two. I'm surprised it is where it is. I expected to crash heavy this year, actually. And the fact that it's still up here where it's at is surprising to me. So, but as Tripp said, irrational exuberance, right? And the market can stay overbought for a long time. You're getting back to it. That's good. Yeah, be patient with yourself for one, and don't be afraid to stay on the sidelines. Make sure you know what you're doing. Figure out what your trading style is. Make sure that you have a good, solid plan in place that fits your trading style, your personality, your risk tolerance, and all those different factors, right? So create yourself a good, solid trading plan, and then stick to the plan. And if you've got a good plan and you're sticking to it, you're not deviating from it, and you've got the risk reward on your side, kind of like this, right? I mean, if you were to buy puts on IBM at 159.54 and it hits the target, you're making, $7-8 on your option, right? You got $10.5 of profit. You get stopped out, you're losing $3.5. That's 3 times as much upside. So if you had this exact same trade 4 times over, and you get stopped out 3 times and you hit it once, you break even, right? If you get stopped out twice and it hits twice on the profit, you've lost $3.5 twice. That's 7. You've made $21 of profit. $21 of profit, $7 of loss. You're still up $14. So you're welcome, Tom. Have a Merry Christmas. All right, see you, Trev. I know I got to run too. Sorry. So you know what I mean? So Gwen, make sure you have a solid plan in place and figure out which strategy is best for you, what works for you, for your personality, your risk tolerance, and just have all that in place. Create your rules and stick to them. That's the most important part. So yeah, be patient. No hurry. Market's always here. So thank you, Helen. Exactly. That's what I was just going to say. I'm going to shut up now because I've gone 11 minutes too long. So yeah, Merry Christmas, Happy New Year to everyone. Because I think I have one more trade you before the end of the year, if I remember right. Maybe not. So anyway, all right, y'all have a wonderful day. God bless. We'll see you all next year. Bye bye.